Hello friends, welcome to this amazing chapter AS15 again. Today's day is very important because you are going to learn about post-employment employee benefit plan and long-term employee benefit plan. For accounting purpose, this will be divided into two types. One is called defined contribution plan, that is DCP, and second is called defined benefit obligation, that is DBO. So now we are going to discuss the important features of these two plans, how they are different and what is the difference in the accounting treatment. In case of post employment plan and long term employment benefit plan, the first thing we need to ascertain, we need to identify whether it is a defined contribution plan or whether it is a defined benefit obligation plan, because the accounting will accordingly be changed. Is it right? So first, our topic for next few minutes would be defined contribution plan. Defined contribution plan, why it is called defined contribution plan? If you try to guess from the heading, you will be able to guess. Defined contribution plan means the employer, the owner has the obligation to make certain contribution. The employer has an obligation to make certain contribution towards the plan, and if he has contributed that amount which he is obliged to contribute, which he is supposed to contribute, then his liability is over. Then he is no longer liable. But if he has not contributed what was defined, what was agreed, what is required by the law, then his liability will continue. For example, let us say Provident Fund. Let us say Provident Fund, PF. Suppose the law says employer has to contribute 8.33% of basic salary plus DA, dearness allowance. This is defined by the law that the employer has to contribute every month 8.33% of the basic salary plus DA. If he has contributed, if the employer has contributed that amount, then his liability is over. If he has not contributed that amount, then his liability is not over. So this is just one example. There can be any such benefit which might be agreed between the employer and the employee. Okay, but PF is a very good example. So the meaning of defined contribution plan is employer has an obligation limited up to the contribution required to settle the employee benefit. If you read the example below, it will immediately make your understanding clear that you have to contribute a specific amount of money as required by the law or as agreed between employer and employee. If you make that contribution, then that is, if you pay that amount, then your obligation is over and you are not obliged to pay anything more than that. Like in PF, you have to compute your share 8.33% and deposit that amount with some PF trust maintained by usually the government. Once you go and deposit that amount in that PF trust, employer's obligation is over. Then when the employee will retire, the trust is going to make the payment to the employee. The trust will directly make the payment to the employee. PF trust will make the payment to the employee. Employers is not required to make any more payment. If the PF trust give more amount, it is the employee's good luck. If the PF trust pays less amount, it is the employee's bad luck. So who is going to enjoy any gain or loss? If the PF trust gives more or less amount, it is the employee who is going to either gain or loss. Such plans are called defined contribution plan. Okay. Defined contribution plan means employer has to pay a certain amount. Once he has paid that amount, his obligation is over. Next is, where will the contribution made? Contribution has to be deposited somewhere, invested somewhere. So contribution made by the employer. Some companies, what they do, they also deduct a similar amount from employee salary, but that is not necessary every time. Some companies deduct similar amount from employee salary. The reason is that this will save money for the employee, so that when he will retire, he will have a huge amount of money, because after retirement at the age of 60-65, getting a new job will be difficult. So therefore your savings, your investment at that time would be useful. So employer's contribution plus employee's contribution, if any, will be invested in either multi-employer plan. Multi-employer plan means many employers come together and they manage the funds. That is multi-employer plan. Most commonly is your state plans, where the government, central or state government, they manage the funds, and when the employee retires, they make the payment to the employees along with the return generated by these funds or this trust. Or the contribution can be made to insurance companies also. That is called insurance plan, where you contribute to the insurance company and the insurance company will pay to the employee when he retires. Or the fourth way to contribute is, you can create your own trust, another entity which is called trust, registered under the Indian Trust Act. You create that entity, and through that entity the deposits will be made, that will be handling the investment. When the employee will retire, the trust is going to make the payment to the employee. Such plans are known as, such plans are known as defined contribution plan. Next question is, very important question is, who bears the risk in case of defined contribution plan? That means we are making investment. That investment may give low return than expected. Who is going to take that risk? Under the defined contribution plan, who is going to take that risk? Please guess. Option A is employee. Option B, employer. Who is going to take the risk that something can go wrong and the employee may not get the desired amount, the expected amount? So who is going to take that risk? So you have to answer option A, employee, option B, employer. If the risk is borne by the employee, it is a defined contribution plan, because the employer has already contributed what he was supposed to contribute. So any risk is to be borne by the employee. Very, very important for theory question, MCQ question, conceptual question. In case of defined contribution plan, all risks are borne by the employee. The important risk is risk related to return on the funds or the repayment of the funds. Funds may not generate enough return. The amount may not be repaid due to any problem. That risk is with the employee. If that is the case, if the risk is borne by the employees, employer is no longer obliged to pay except his contribution, and if he has contributed that amount, he is no longer liable. It is a defined contribution plan. Now again, important point is accounting treatment of defined contribution plan. Amount to be contributed by the employer, is treated as employee benefit cost. It is also a form of salary. It is also a form of remuneration. So what is the treatment of remuneration to employees? it is treated as a cost and it is transferred to profit and loss account. Just mention here unless it can be capitalized, under other accounting standards. For example, accounting standard 10, accounting standard 26. Because if an employee is involved in construction of a property, plant and equipment, then his salary will be capitalized over the cost of that property, plant, equipment. If the employee is involved in development of an intangible asset like software, then his salary would be added to the cost of the intangible asset and will not be charged to profit and loss account. Second point is, do we need to do discounting? That's a good question. Do we need to do discounting? So this is our balance sheet date. This is 12 months timeline, 12 months from balance sheet date. 12 months from balance sheet date. If the amount is payable within 12 months from the balance sheet date, in this period, if the amount is payable, if the amount is required to be paid or settled or contributed within 12 months, then no discounting is required. No discounting is required. And if the amount is payable more than 12 months from the balance sheet date, then discounting is required. Discounting means calculating present value. Discounting means present value calculation. Present value means finding today's value, okay, of the future value. Finding today's value of a future value, because time value of money is important. Students might have studied in your schools also, 12th standard also, or foundation course also, how to calculate present value of a future value. Present value is equal to future value upon 1 plus r to the power n. So we are going to use this formula in some problems, don't worry. Now if you look at this chart, it is very similar to short term employee benefit accounting. It is very similar to short term benefit accounting. Whenever you make the payment, you will pass the entry. Whenever you make the payment, you pass the entry employee benefit account debit to bank. This is for contribution paid. This is for contribution made. But suppose at the end of the year, you find that certain amount is not yet paid. Some amount is outstanding. Some amount is pending, because usually in the month of March it may happen the payment for March is made in the month of April, because let the month get over, then on the 1st, 2nd, 3rd, probably you are going to make the contribution to the state plan, multi-employer plan or insurance company or trust. So in that case, as on 31st March, you will have to create a liability. The entry number 2 will be employee benefit account debit to provision for employee benefits. Either you can write provision for employee benefits, or you can write employee benefits payable, or you can write, if you are comfortable with that, you can write employee benefits payable. And this employee benefits payable will be shown in the balance sheet. Current liability will be presented in the balance sheet under the head current liability on the liability side. And it is also possible that you have paid more than what was accrued. you have paid more than what was accrued. In that case, if that happens, usually it will not happen, but suppose that happens, then you have to pass entry for prepaid employee benefit. Good student will note down to employee benefits, like your accounting of salaries and wages. If the amount paid is more than the amount accrued, if the amount contributed is more than the amount accrued, prepaid employee benefit account debit to employee benefit, and then you will transfer fourth entry P&L account debit to employee benefit. P&L account debit to employee benefits. But sometime capitalization can also be done. Sometime you may have to capitalize. If you have to capitalize, instead of P&L account debit, asset account debit. If you have to capitalize the expense, because the employee may be involved in construction of PPE or development of intangible asset, it will be added to the cost of PPE or intangible asset. The entry will become asset account debit to employee benefit account. So these are the four entries, usually 4 or 5. Yes, 4 entries usually we will pass whenever you have to pass entries relating to employee benefits under defined contribution plan. Okay, let us take some examples to understand. I have taken questions from reference book also. Okay, I have taken for questions from reference book also, that will help you to get your doubts cleared, that will improve your conceptual understanding. So we are going beyond the institute module and taking additional questions. In accordance with applicable legislation, company contributes 12% and employees contribute 12% of annual gross salary to the provident and pension fund. So here the employer has to contribute 12%, employee also contributes 12%. Upon retirement, the employee will get the accumulated balance, that is calculated based on employee's year of service and his average salary for past 15 years before retirement. So this is the formula to calculate the amount that is paid to the employee on retirement. He will get the payment equal to number of years of service and multiplied by average salary, which is based on last 15 years. But the question says the pension will be paid out of the state fund asset. This is important line. The pension will be paid out of the state fund asset and the company has no further obligation except to make the contribution. Company has no further obligation except to make the contribution. So please take a red pen and underline or highlight, because this contains the answer of your question. If you miss this line, you have missed the answer. Company has no further obligation except to make the contribution, and the company has to contribute 12% of his own share and 12% which they have deducted from the employee share, that also needs to be contributed. If that much amount is contributed, company is having no obligation. Now the question is, would this obligation represent? Now this can be a multiple choice question also. Option A, whether the above case study is a defined benefit obligation or a defined contribution plan. So the answer is very simple. It is a defined contribution plan, because read this highlighted one, company has no further obligation except to make the contribution. Hence such plans where the employer's obligation is limited to the extent of contribution to be paid, such plans are called defined contribution plan. So the answer is also printed here. Okay, the answer is also printed. Defined contribution plan. Reason: although employer's pension is determined in advance by a formula and thus employees neither carry actuarial nor investment risk, company's liability is limited to the contribution to the fund. I will again highlight, at the cost of repetition, company's liability is limited to the contribution to the fund. If that be the case, if that is the case, then it is the defined contribution plan. In that case, pension will be paid out of the state fund. It is state fund which carries all the risk. State fund has to pay to the employee. Whatever is the formula, employer is not required to make any contribution. So what is the summary of this answer? As the employer's liability is limited to the extent of contribution to be paid, he is not required to pay anything over and above the amount of contribution to be made. This is a defined contribution plan. The ultimate risk is on the state fund, which has promised the employee to pay a certain amount according to a certain formula. Now we'll take one more question. Source is reference book for your benefit. If you read more, practice more, you will be able to score more in the exam. ASF Limited makes contribution to pension fund of employees at a rate of 5% of the gross salary. So they are making contribution to a pension fund. But read the full story. For convenience, the entity pays 10,000 per month into the pension scheme, with any balance being paid in the first month of the following accounting year. The wages and salary for 2006 comes to 2.7 million. So now what is the amount accrued? Amount accrued will be 2.7 million into 5%. 2.7 million means 27 lakh. Take on your calculator 27 lakh. 27 lakh is 27 followed by 5 zeros into 5%. So the amount that you are supposed to contribute is 1,35,000. Amount paid or amount contributed, pays 10,000 per month. 10,000 into 12 months. Amount paid is 1,20,000. Amount paid is 1,20,000. Therefore, amount payable will be 15,000. Difference between 1,35,000 and 1,20,000. Then what is the question? Required calculate the pension expense for 2006 and the accrual or prepayment at the end of the year. So the answer is, I can explain with the help of journal entry also. You will pass an entry, employee benefit expense in bracket pension debit 1,35,000 to bank, actual payment made 1,20,000 to employee benefits payable, in bracket pension. You can write the entry if you are a good student, 15,000. So this gives you the entire answer. What is the pension expense? Pension expense is 1,35,000. And how much is the accrual at the end of the year? Accrual or payable at the end of the year would be 15,000. And second entry write down. P&L account debit 1,35,000. P&L account debit 1,35,000. If you are asked to write entries, then you should be prepared. to employee benefit expense account in bracket pension 1,35,000. 1,35,000. You may be asked to write entries also. Who knows? This is your institute. 2 entries are enough. 2 entries are enough. Employee benefit expense account debit 1,35,000, to bank account 1,20,000, to employee benefit payable account 15,000, that will be transferred to balance sheet liability side, current liability, and P&L account debit 1,35,000, to employee benefit expense account 1,35,000. Same answer is printed in your book also. This is a defined contribution plan. This is a defined contribution plan scheme because the employer has to contribute 5% of the salary. Okay, and once you have contributed that 5% of the salary, your liability will come to an end. So in the given example, the amount to be recognized in P&L account is 1,35,000 and the amount to be shown in the balance sheet is 15,000. Accounting of defined contribution plan is over. We don't have too many questions on that. The important part is defined benefit obligation. Now see the heading, defined benefit obligation. What is benefit? Defined benefit. Employer has committed. Employer has an obligation to pay a certain amount of money. Employer has an obligation to pay a certain amount of money and he has to pay that amount of money. His liability is defined by a formula and he has to pay that amount. Even if he makes investment in a trust or insurance company or a state fund or a multi-employer plan, his liability does not come to an end. Whatever is promised to the employee, he has to pay, and such plans are called defined benefit obligation plan or DBO in short. Is it right? So suppose the employer says to the employee, in the agreement between employer and employee it is written gratuity will be paid equal to 5% of last drawn salary into number of years completed. So this is the contract. Okay, so when the employee will retire, suppose his last salary is 10 lakh rupees and he has completed 25 years in the organization. So the company is obliged to pay him 10 lakh into 5% into 25 years, 12,50,000. Company has to pay him 12,50,000. Come what may, company has to pay him 12,50,000. So he has to pay the benefits which is defined between the employer and the employee or by the law. And even though the employer may be making some investment, possible, he may be making some investment in a trust or some insurance or some other investment, but if that investment does not generate enough return, he is still liable to pay. Then in that case it is called defined benefit obligation. Liability of the employer continues until he makes the payment to the employee as agreed. Okay, so who is going to take the risk now? In a defined benefit obligation, who carries the risk? Option A. Who carries the risk? Option A, employer. Option B, employee. Okay. What would be the answer here? What would be the answer? The answer would be employer. The answer would be employer. If the answer is employer, then it is a defined benefit obligation. All risk relating to settlement, repayment, return are with the employer. So that is my first answer. Next question is, now the employer knows that when the employee will retire, I will have to pay him 12,50,000. I will have to pay him 12,50,000. So what he can do? Employee will retire after 25 years. But every year, as he is rendering the service, your obligation to pay him increases. Your obligation to pay him increases. So what you can do? Every year, you can set aside some amount in a fund, in a trust, in an investment, in insurance, in a multi-employer plan, in a state plan, so that when the employee will retire here, you will have enough funds to make payment to him. That is your fund management. Because suddenly if somebody will ask you to pay him 12,50,000 from your business, you will have a cash flow problem. Your operations will be affected. So what a prudent company will do, what an intelligent company will do, they will keep aside some amount every year so that when the employee will retire, this investment made plus the interest or income generated on that investment will be sufficient or almost sufficient to pay the amount payable to the employee. If the employer says, I will not take a chance, I want to invest the amount, when the employee will retire, I will pay him out of the investment. Like in some 12th standard class or in foundation, I don't know, if you have a fixed asset which you have to replace after 10 years, you create a sinking fund. You keep depositing some amount in a sinking fund which generates interest income. After 10 years, when the fixed asset have to be replaced, you sell the sinking fund investment, raise the funds and purchase the fixed asset. Concept is same. Employee will retire, we have to pay him. So why not to keep aside some amount every year in a fund or an investment? With interest, the amount will be sufficient to pay the liability, amount payable to the employee. So that is called fully funded. Some company may go for partial funding. They may not put enough money. They may put some money. They will say some amount I will pay from my bank balance at that time and some amount I am going to invest. That is partially. Some company which are cash rich company which has got huge cash and bank balance, okay, or who are, you can say, careless company also, they may not do the funding. They will say we will see, okay, we will see. When the employee will retire, that time we will see and we will pay him out of the balance in our account at that point of time. We don't want to block our funds. So we'll pay to the employee at the time when you retire from our day-to-day cash and bank balance. So that is called unfunded. Okay. Now you will answer my question. Is funding mandatory? Is funding mandatory by AS 15? Does AS 15 make it mandatory to put some amount in a fund? The answer is option A, yes, option B, no. Is funding of defined benefit obligation mandatory under AS 15? Choose the right answer. Yes or no. Is funding of defined benefit obligation mandatory? The answer is no. Funding is not mandatory, it is left to the enterprise. Our accounting standard cannot force you how you should manage your day-to-day cash, how you should manage your operations. Accounting standard will only tell you how to do accounting if it is funded, how to do accounting if it is unfunded. Is it right? Next is, I have written the meaning of funded also. Funded means employer is accumulating funds for settlement. That is funded. Keeping amounts of money, like your parents will deposit some amount, okay, in some investment, some FD. The purpose is, when my child will become an adult and he will go to college, we will require 20 lakh for his higher education. So this deposit made every year will also become 20 lakh or something around that, so that the college fees of the kid can be paid out of this investment made, out of this savings made. Exactly same logic we are using for understanding purpose. Funded means employer is accumulating fund for settlement, called plan asset. These investments are called in this chapter plan asset. Amount invested by the employer is called plan asset, and unfunded means employer is not accumulating the fund. Okay, so that is the meaning of funded versus unfunded. And plan asset means investment can be made in a multi-employer plan. As we discussed that these are the funds managed by many companies together, so that the overall cost of funding can be reduced. State plan, that is managed by central and state governments. Insurance plan, which are managed by these big insurance companies. Okay, they said you don't worry, you give amount to us, we will manage and we will help you in settling the employees, or you can manage through your own trust. Like for example, companies like Tata, Reliance, they have their own trust. They have their own trust managed by trustees, and they take care of the welfare of the employees. So there can be own fund, own trust also. Now come to the next part. You have to continuously pay attention. Okay, continuously attention is required, otherwise you may miss something important. So how do I do accounting of defined benefit obligation? How do I do accounting of defined benefit obligation? First we need to find out the liability. Okay, what is liability? Now the student will have to really pay attention to understand this part. This is, let us say, our year ending 31st March 2025, and this is the date of retirement. Date of retirement, let us say 31st March 2040. Okay, so employee is rendering services every year. The employee is rendering services every year, and you have promised to pay him retirement benefit, you have promised to pay him long-term benefit. Is it right? So in that case, the liability is accruing every year. The liability has accrued because it's rendered service. Company has got the benefit of the service. Company's sales have increased, production has improved. So the benefit has been received, which is reflected in higher production, higher sales. But the payment to the employee, payment will be made. Payment to the employee for the service rendered here will be made when he will retire. When the employee will retire on 31st March 2040, then you are going to make him the payment for the services he has rendered in all these years. That is retirement benefit. For the services that you render over the service life, you get compensation for that at the time of retirement. So payment will be made on 31st March 2040. Payment will be made on 31st March 2040. Is it right? Now this is a difficult calculation. So payment will be made. First of all, first question will be how much payment will be made on 31st March 40. It may not be an easy calculation. Why? Because the agreement with the employee is that you will get 5% of last drawn salary. 5% of last drawn salary multiplied by number of years of service. This is a simple formula. There can be any other complex formula also to calculate the amount payable. Now the question is, you are here on 31st March 2025. You will have to estimate what would be the last salary on 31st March 2040. Will you be able to estimate easily? You are a normal human being. Where you will be after 2 years, you don't know. Where you will be after 2 hours also, you don't know. You are so restless person. Okay. Continuously there is a restlessness going on. So after 2 hours, you don't know, and you are talking about 15 years. You are talking about in some case 30 years. So here I need the help of expert called actuary. For defined benefit obligation, in order to calculate the liability, I would require the help of an expert called actuary. A-C-T-U-A-R-Y, actuary, not actually, actuary. Actuary are professionals who are trained, okay, who are expert in this field of making calculations relating to future salary, future pension, future medical costs, and so many other things. It is also almost 3-year course. There are about 12 to 14 papers which are very difficult, like your current course. Is it right? So you go to them, you give them data relating to employees, what is his salary, what is the terms and conditions. So you give him all the details about your employees, and the actuary, using his knowledge and expertise, will give you one actuary report. In that report they will give you exactly how much would be your liability. Again, that is based on his estimate, but his estimate would be better than our estimate. If somebody comes to us for advice on taxation, we can give a better advice because we are trained in the field of accounting, taxation, law, audit. Similarly, somebody goes to actuary for predicting the liability relating to retirement benefit. He is trained in that field. He can give a better opinion. So that is only difference. Okay. So actuary will help you to calculate your liability, because I have to make a provision here. I have to create a liability here. As the liability has accrued, employee has rendered the service, we are obliged to pay. So liability has accrued. Only thing is that the payment is not made immediately. The payment will be made after certain number of years, which can be a very long time period, like 5 years, 10 years, 15 years, 20 years, 25 years, 30 years. So my next question is, payment will be made after 15 years. Liability has to be recognized today. Option A, discounting is required. Option B, discounting is not required. Come on, option A, in order to calculate the liability, if I have to pay suppose 100 rupees here after 15 years, how much liability should be recognized today? Should it be 100 rupees or present value of 100 rupees? The answer is present value of 100 rupees. Discounting is required because the impact of time value of money is very important here. 100 rupee after 15 years and 100 rupees today are not equal. Time value of money is very critical, very significant here. Okay, and therefore the standard says because the time value of money is very important, very significant here, you need to do discounting. You need to do the discounting or you need to compute the present values. So I have given lot of background. Let us read the next point. If defined benefit obligation is to be calculated, then projected unit credit method should be applied. So the standard says for calculating the liability, the method used is called projected unit credit method. For some MCQ question, it is relevant. How to apply this? We'll take a question after some minutes and you will understand. Till that time, have patience. The method for calculating defined benefit obligation is PUCM, projected unit credit method. That is, the liability will keep on increasing every year as and when the employee renders the service. As and when the employee renders the service, the liability will keep on improving every year. So what are the steps we will perform to calculate the liability? Now the student can ask, if the liability is to be calculated by the actuary, then why we are taught? As an accountant, as an auditor, you have to know how the liability is calculated. So our syllabus contains some basic understanding of how the liability is calculated. Okay, once you qualify, then you are not required. Then the actuary report will be used. Based on actuary report, you will have to do the accounting. But then as an intelligent person, one should understand, yes, whatever is written there, am I able to understand? Can I understand this actuary report or not? So after today is your life changing day, you will be able to understand some portion of those actuary report, okay, which are little complex for a normal man, but for you, you will be able to now understand. So I would request you, have patience for next few minutes and you will be able to solve questions on defined benefit obligation. So following steps are required. First is estimate liability by making suitable assumptions, which are called actuary assumption. Oh my God, actuary is also required to make assumption. Yes, why? Because future is uncertain. Nothing is certain about future. The uncertainty about future is the only certainty about future. Okay, so what are the assumption he has to make? For example, he has to assume at what rate salary will grow. He has to assume when he will retire. He has to assume, suppose the company has promised to pay medical benefit after retirement, what would be the medical cost? He has to assume what would be the inflation. Okay, he has to assume what will be the rate of return on the investment. So much of assumption is involved about future. So the actuary has to make assumption. These assumptions made by actuary are called actuary assumption. Actuary assumption or actuarial assumption. But our standard gives you some guideline while making assumption. The assumption should be market based. That is, it should be based on whatever interest rate, inflation rate are there in the market. It should not be a guesswork. It should not be biased. Biased means your own judgment gets involved. You have to see what is the trend in the market. Government gives you inflation data. Government says inflation will be 5%. You can't assume 20%. You can see what is the trend in the salary growth. The salary growth is 5%, 7%. You can't assume 70%, 35% salary growth rate. That is biased. It should be compatible. So all assumptions should be consistent. For example of consistency, you are assuming inflation rate will be 7%. So inflation rate, interest rate, if you are assuming inflation rate is 7%, what will be interest rate? Can you guess? Interest rate should be more than inflation rate. Let us say 9%. This is compatible assumption. This is compatible assumption. But if you say inflation rate will be 7% and interest rate will be 3%, this is incompatible assumption. This is incompatible assumption, because in every country where interest rate is high, inflation rate is high, the interest rates are higher. In Japan, inflation is low, so interest rate is low. In USA, inflation is low, so interest rate is low. In India, the inflation is high, so interest rate is high. That is compatible assumption. Okay. Next is, assumptions are two types. One is called demographic assumption. Demography means related to population, because human beings are unpredictable creature. What a human being can do or will do can't be predicted easily. So therefore assumptions are required. Assumption about labor turnover, that is how many employees would leave. It is called attrition rate. Nowadays very few employees would complete 25 years in an organization. They keep on changing the job, they keep on hopping the job, and that you need to assume about that. Death rate, you have 4 lakh employees in TCS, not everybody will complete the retirement date, some may die. Claim rate, how much amount is payable, how many of them would claim. Okay, if there are family pension, how many families would claim. All this you have to consider. Example. And then there are second type of assumption called financial assumption, related to finance, like discount rate, that is interest rate. Okay, for present value calculation, you have to pay attention, otherwise you will not understand this chapter. In your study module they have not explained in detail, but we have added extra notes, extra paragraph to make you understand. Second assumption is about expected rate of return, which means return on investment. You are going to invest some amount every year. In case if it is a funded plan, then you are going to get some return on investment. Calculate that. Then you have to estimate about salary escalation rate, that is growth in salary. At what rate salary will increase, because some defined benefit obligation are based on salary, maybe average salary, last drawn salary. So all these are required to be estimated. While estimating expected rate of return, this one, while estimating expected rate of return, you will have to take into account whatever interest or discount income on investment. It should be dividend, make it dividend, interest or dividend income on investment, interest and dividend income on investment. Okay, because you have made the investment. If you have invested in debentures, bonds and debt security, you will get interest. If you have invested in mutual fund or share or preference share, you will get dividend. So that is what you receive. Second thing, you may have sold some investment, that is called realized gain or loss on investment. Third, you may not have sold, but the value of the investment has increased or decreased. That is called unrealized gain or loss on investment. So whatever, it is called capital appreciation, capital gain or loss. I think that is easy to understand. And third is you have to deduct cost to administer the investment, that is expenses involved in managing the investment. Expenses involved in managing the investment. There are costs involved. Nothing is free. So minus that, take the total. This is your expected rate of return. This is your expected rate of return, right? And then step number 4, calculate allocated benefit. Step number 4 is calculate allocated benefit. Using step 1, we have computed our liability. Do you remember step 1? Step 1 is estimation of liability. Allocated benefit means liability divided by service period. Liability divided by service period. So if my estimated liability is 12,50,000 and the employee is going to serve 25 years, my benefits allocated per annum would be rupees 50,000. Okay, that is called allocated benefit. So if the employee is going to render service for 25 years, we are going to pay him 50,000 rupees for each year of service rendered. We are going to pay him 50,000 rupees for each year of service rendered. So if he has rendered service at this point, we are going to pay him at the end of 25th year 50,000 rupees. Okay, that is allocated benefit. Now the next calculation is calculate current service cost. Current service cost means the benefit of employee service rendered for the current year. The cost incurred by the employee because the employee has rendered service in the current year. Cost for current year service. Cost for current year's service. Every year, now understand, every year the employee is rendering the service. The moment the employee renders the service for a year, employer's obligation increases. If the employee renders service in year 1, you have to pay him 50,000. If he renders service in year 2, you have to pay him another 50,000. If he renders service in year 3, you have to render another 50,000. But it has to be discounted. Why it has to be discounted? Let us understand. You are here 31st March 25. This is my year ending date. Let us say 31st March 30, employee will retire and we have to pay him 50,000 into 5. Each year of service entitles him to receive 50,000. This point is very important. You have to pay him 50,000. Okay, when he will retire. When will you pay him 50,000? When he will retire. How many years are left when he will retire? 5 years. Liability has accrued at this point. Payment will be made at this point. There is a gap of 5 years. Liability has accrued because he has rendered service. Payment will be made at the end of 5 years from today. So I need to compute present value. How do I compute present value? 50,000 divided by 1 plus r to the power n. 50,000 divided by, suppose interest rate is 10%, 1.10 to the power 5. So now the student will have to take out his calculator. 50,000 divided by 1.10, press equal to 5 times. You will get something like 31046. You will get 31046. Just check. Okay. So that is called current service cost. Means the employer will have to provide for a liability equal to 31046. So on 31st March 25, we are going to pass an entry, current service cost account debit to defined benefit obligation account 31046. This is how we do the accounting for defined benefit obligation. So I'll repeat the step. First, to estimate the liability, then you find allocated benefit and find out the current service cost, which is the present value of the allocated benefits. Okay. Every year you have to do this exercise. Every year you have to compute current service cost, but the amount will not be same. Sir, why the amount will not be same? The amount will not be same because next year on 31st March 26, there is a gap of only 4 years. So my current service cost will be equal to present value of 50,000, but this time the number of years will become 4. The number of years will become 4. So calculate the present value. 50,000 divided by 1.10, 4 times equal to 34151. That will be my current service cost obligation on this date. Suppose I go to this date, 31st March 27. There is a gap of 3 years. So if I have to compute the current service cost on 31st March 27, it will be 50,000 divided by 1.10, 3 times equal to, that comes to 37565. Oh, so see the task of an actuary. In an organization there are lakhs of employees. Everybody has a different salary structure. He has to estimate the salary, find the allocated benefit, find the current service cost. So that is why this task is assigned to an expert called actuary. For one employee we have to do so much calculation. So for lakhs of employees, you can imagine how much calculation is required. So we are going to create or build or prepare a statement which is called liability sheet. That is, how much will be liability at the end of each year. How much would be the liability at the end of each year? That is called liability sheet. So we are going to do this after some time. The students are requested to have some more patience. Question is now coming soon. So what are the journal entries to be passed? Journal entry to be passed in case of defined benefit obligation is like this. Every year, because the employee renders the service, there is an obligation to pay, but that payment is made after many years. So I compute the present value of that obligation, which is called current service cost. I have told you how to do it. Then we'll have to debit interest cost. What is interest cost? Interest cost is opening liability multiplied by interest rate. Opening liability multiplied by interest rate or discount rate. Now why it is required to be calculated? Why it is required to be calculated? That's $1 million question. So for that, let us understand, this is my 31st March 25, this is 31st March 30, we have to pay him 50,000 rupees for rendering service in this year, but the payment is made after 5 years. So I am going to compute present value of 50,000, which was, I will calculate again, 50,000 divided by 1.10. So how much is the liability? We have computed 31046. A good student will now understand, we will record 31046, but actually the payment to be made is 50,000 after 5 years. So every year I will have to add interest so that after 5 years this amount will become equal to 50,000. So that this amount with interest will become equal to 50,000. That is called in technical language unwinding of discount. Otherwise you forget it. Unwinding of discount. First we discounted it by 10% and reached 31046. Now we are going to add 10% every year and reach 50,000. So first you discount, you get present value, then every year you add 10%, 10%, 10%, you will reach 50,000. So that is interest cost. So interest cost will be applied on 31st March 26. Opening balance was of the liability is 31046 into 10%. That will be approximately 3105. So in the second year we are going to pass an entry for interest on opening liability, because on opening liability you have to add interest, because you have to make it equal to 50,000 in 5 years time. So how do I do it? If I add 10% every year for 5 years, the opening obligation of 31st March 25 will become 50,000 after 5 years. So these two accounting you have to do every year, and you will credit to PV of defined benefit obligation. This will be transferred to P&L account. It is an expense. This will be transferred to P&L account as an expense, and this will appear in balance sheet liability side, non-current liability, because the liabilities are usually payable after a long time period. So they will be shown as non-current liability. Okay, this is my entry. Now next is, just make a correction in your book. If anything else is written, you make it actuarial loss. Actuarial loss account debit to PV of DBO. Now the student will ask me, what is this item? So you'll have to have some patience. When the actuary make assumption, his assumption may change or his assumption may go wrong. Any gain or loss due to change in actuarial assumption or difference between actual outcome and outcome expected by the actuary is called actuarial gain or loss. Actuarial gain or loss, because actuary is not a god, he also is a human being, he also makes estimation, and as you know, estimations can be different from the actual outcome. So that difference between actual outcome and expected outcome, the difference between what was expected by the actuary and what actually happened. For example, actuary may assume that expected return on investment will be 11%, but actually it was only 10%. Actuary may assume that salary will increase at 7%, salary may increase at 8%. So these are the changes possible or differences possible. These differences are called actuarial gain or loss. If it is loss, the entry will be actuarial loss account debit to PV of DBO. If there is an actuarial gain, the entry will be, you can mention here, if there is actuarial gain, something good happens and your liability is reduced, the student will pass the entry PV of DBO account debit to actuarial gain account. Where will this actuarial loss be transferred? P&L account. Where will this actuarial gain be transferred? To P&L account. So if there is any actuarial gain or loss, it will be transferred to profit and loss account. And this entry I have already explained. The current service cost, interest cost, even the actuarial loss will be transferred to profit and loss account. So usually every year this entry will come. P&L account debit to current service cost, to interest cost, and to actuarial loss also you can write if you want, to actuarial loss. 3 items. So normally these 3 items will hit the P&L account every year for defined benefit obligation. Let us first solve few questions. I have tried to keep it simple. Question number 13, taken from your study material. A company pays each employee a lump sum one-time benefit upon retirement. The benefit is computed based on employees' years in service in the company and the final service and the final salary prior to retirement. So this is the formula for computing the benefits payable on retirement. It depends on number of years of service. It depends on final salary. Okay. To cover the liability, its liability from remuneration, the company contributes 3% of annual gross salary to the fund. So this is funded obligation. This is called funded obligation. If the employee will retire, you should have enough investment so that you can pay to the employee who is retiring. Would this obligation represent a defined contribution plan or defined benefit plan? Good question. You have to choose. Suppose this is an MCQ question and you are given option A, it is a defined contribution plan. Option B, it is a defined benefit plan. My learned students, please reply. Based on your reading, what does it says? Who is having the obligation? The employer is having the obligation. Take a red pen. Okay, red pen. What is his obligation? Employer's obligation to contribute an amount equal to employees' years of service multiplied by final salary prior to retirement. Now this is just a funding exercise. Making 3% of this salary to a fund is a funding exercise, so that you don't have a problem when the employee retires, you can pay out of the fund. But the obligation doesn't come to an end. The obligation to pay this amount continues. So if this fund does not have enough asset, if the fund does not generate enough return, the balance amount will have to be paid by the employer from his pocket. Employer's obligation doesn't come to an end even if it has made a contribution of 3% of salary. That is only for funding the liability. The obligation to pay number of year of service rendered into final salary remains with the employer. So this is a defined benefit obligation plan, and the institute has written the answer also. Why? Although the company pays contribution to the fund to cover its liability, the amount of remuneration is determined in advance and company will have to carry the risk in case the fund's assets are not sufficient to cover the remuneration in full. Okay. Now please, my dear student, we are going to take one question. It's a very funny thing that your institute does not have a proper question, a proper numerical question on defined benefit obligation, even though they have written so much. But how will the student understand without a numerical example exactly how this projected unit credit method works? So here we are going to take a question from a reference book which will help you to understand the entire process, the entire accounting of defined benefit obligation. So are you ready? Are you ready? Okay, let us start. ASF Limited has a defined benefit plan. So the question has already made it clear. It is a defined benefit plan. Otherwise, I would have asked you first this question, what kind of plan is this? For bonus payable at the end of the 5th year of service at 10% of salary. So what is the formula for payment of bonus at the end of 5th year? 10% salary last drawn. So you will have to first calculate last drawn salary multiplied by 10% and multiplied by each completed year of service. Okay, the formula for making payment to employee is 10% into last salary into number of completed years. This is what they have defined or agreed to pay to the employee. So we will have to estimate here last salary first, and then the total amount payable, and then per annum amount payable. So students will pay attention. Employee has a salary of 50,000 rupees per annum in year 1. Okay, this is the first year. Year 1, this is year 2, this is year 3, this is year 4, this is year 5. So in this period, in this first year period, his salary was 50,000. In this first year period, salary is 50,000. I hope this is understandable. Now the actuary has made the assumption salary escalation rate is 10% per annum. So salary will grow at the rate 10% per annum. So next year salary will be how much? 50,000 plus 10%, 55,000. Then the next year salary will be 60,500, add 10%, then 66,550, and then when he will retire, his salary would be 73,205. His salary will be 73,205. Is it understandable? Now in the exam you cannot do so much calculation. So there is a direct way to reach this number. 50,000 rupees salary will grow at the rate 10%, so into 1.10, and for salary will grow for 4 more years. Can you see that? Because he is already getting 50,000 here. So appreciation in salary will be over 4 more years. So I will take power 4. Now students are requested to solve. How do I solve? First you type 1.10 on your calculator. 1.10 into, if the power is 4, press equal to 3 times. 1, 2, 3. You are getting 1.4641 on your calculator multiplied by 50,000. You will be very happy to get same answer. So this is the last drawn salary. This is the last drawn salary. Okay. So his amount payable will come to 10% when he will retire. 10% of 73205 multiplied by 5 years. Multiplied by 5 years. So the amount payable to this person will come to 36602.50, which we can round off to 36,600 approximately, no problem. Okay. So this way the student has to compute how much amount he will get at the time of retirement. Next point is discount rate is 8%. Discount rate is 8%. So I will have to use 8% for computing present value. This 10% is for salary growth, which is different from interest rate. Interest rate is a different thing. Okay, interest rate means discount rate. If I am computing present value, I say it is discount rate. If I am computing future value, I call it as interest rate. Past journal entries. So one question is past journal entry, but for that we will have to do calculation. And second is we have to show extract of year 1 and 2. Very good question. Extract of what? Extract of balance sheet and P&L account. How the balance sheet and P&L account would look like with respect to this question. That is the effect of whatever we calculate, how that will be reflected in the balance sheet and profit and loss account. So I am sure you are ready. You want to know the answer of this important question? Yes. So please, first let us do some brainstorming. After reading this problem, what comes to your mind? Is it a short-term employee benefit plan? Is it a long-term employee benefit plan? Is it a post-employment benefit plan? Is it a defined contribution plan? Is it a defined benefit plan? Is it a termination benefit? What is this? So this is a bonus payable at the end of 5th year of service. It can't be short-term employee plan, it can't be termination benefit plan. It can be long-term employee benefit plan. Once you complete 5 years of service, then you will get bonus. This is an incentive for staying with the company for 5 years. So this can be a long-term employee benefit plan, or if suppose he will retire at the end of year 5, then it can become a post-employment benefit plan also. Good news is that the accounting is same. Whether you treat it as a defined, whether you treat it as LTEB or PEB. Next question is, if it is either of these two, will you call it defined contribution plan or defined benefit plan? The answer is defined benefit plan, because you have an obligation to pay an agreed amount, which we have computed was 73205 or something. Is it right? This much I have to pay, come what may. So the employer continues to have the obligation to pay this amount. So in your book I have written the answer, tick mark. This is post employment, it is a long term employment benefit plan, because the amount is payable more than 12 months from balance sheet date but before the retirement. Whether it is a DCP or DBP, the answer is simple, it is DBP, because employer has agreed to pay the agreed benefit. What is the method to be applied? PUCM, projected unit credit method. The method to compute the liability is called projected unit credit method. So I will summarize again. It is a long-term employee benefit plan, it's a defined benefit obligation, and the method to be used is called projected unit credit method. Now the student will learn in step number 3 and 4 how the projected unit credit method works. So first you estimate the liability payable when the employee will complete 5 years. Today is getting 50,000. I will repeat for you again. Today is getting 50,000 in year 1. He will get 10% appreciation for 4 years because we have to compute his salary at the end of year 5. By that time there will be 4 increments in the salary. So 1.10 to the power 4, 1.10 to the power 4. This will be his last drawn salary. That is multiplied by 10% because the agreement is that he will get 10% of the final salary for after completing 5 years of service. After completing 5 years of service. So take your calculator and the answer is approximately rounded off 36,600. We have already discussed. So employee will get 36,600 for completing 5 years of service. Step number 4, compute allocated benefit. Allocated benefit means 36,600 will be spread over number of years. So in our example the number of years will be 5. Because of rendering service for 5 years, he is entitled to 36,600 which is equivalent to 7,320 per annum, which is equivalent to 7,320 per annum. Okay. Now we are going to learn to prepare current service cost. How to compute current service cost. Very, very important. Before I go to this table, I would like to give you some idea how this current service cost is calculated. Okay. Very important. Let us say this is the year 1 end, year 2, year 3, year 4, year 5. This is the end of year 1. This is end of year 2. Only understanding is important. Okay. Now employee has rendered service in the first year. This is first year. He will be entitled to 7,320 rupees when at the end of year 5. Liability has accrued here, but the payment will be made at the end of year 5. Again he will render service for one more year and he will be entitled to 7,320, one more 7,320. Then he will render service for one more year. He will be entitled to one more 7,320. He will render service for one more year. He is entitled to 7,320. He is going to render service for one more year. He is entitled to 7,320. So services are rendered in earlier years, but the payments are made at the end of the 5th year. So there is a difference between the date the liability has accrued and the date the liability will be paid, and this gap is significant. This gap is more than 12 months. This gap is more than 12 months. So the standard says the gap is more than 12 months. The impact of time value of money is important and therefore you need to discount it. 7,320 payable at the end of year 5. but I have to provide for the liability today. I have to provide for the liability today. So how much liability I am going to provide? I am going to take 7320 divide by, what is the discount rate? 8%, 1.08. Discount rate is 8%, so I'll divide by 1.08. And how much is the gap? Gap between year 1 and year 5, this gap is 4 years to the power 4. You have to see the gap between 1 and 5. We are at the end of year 1. Payment will be made at the end of year 5. So the gap is 4 years. So you will do the calculation. So that comes to 7320 divided by 1.08, 4 times equal to. So that is approximately 5380. So you'll have to calculate current service cost at the end of year 1 equal to 5380, or there is one more way you can present your answer, or 7320 multiplied by present value factor. Present value factor of have you heard present value factor? Present value factor of, one second please, 8%, 4 years. 8%, 4 years. Present value factor. Now the student can ask, what is the present value factor? Present value factor means present value of 1 rupee. Like for example, if you receive 1 rupee after 4 years, if you receive rupee 1 after 4 years, what is the present value? That is, how much will you be willing to invest today? How much you will be willing to invest today if you get 1 rupee after 4 years, if the discount rate is 8%? That is present value factor. And how do I get it? 1 divided by 1.08, press equal to 4 times. Let us try. 1 divided by 1.08. Listen to me carefully. Next time I will not explain. Next time if you ask, you will have to contribute, okay, a huge amount. So that is 7350. That factor comes to 7350. So 7320 multiplied by 0.7350, and you multiply, you will get, oh wonderful, same answer, 5380. 5380. Are you getting same answer? You will get same answer because mathematically we are doing the same thing. Now we are completed year 2. Liability will accrue here at the end of year 2. Payment will be made at the end of year 5. So we are going to compute present value, which will be 7320. This 7320, gap is 3 years. Gap is 3 years. So you will multiply by present value factor at the rate 8%, 3 years. So you will calculate on your calculator factor first. 1 divided by 1.08, 3 times equal to 0.7938. 0.7938. And when you multiply by 7320, it is 5810. It is 5810. One more I will explain, then we'll directly go to the table. Employee completes 1 more year. He is entitled to 1 more 7320, but he will be paid that amount after 2 years, end of year 5, 3 years. So gap is 2 years now. So I am going to compute current service cost by multiplying 7320 into present value factor at the rate 8% for 2 years. So please check how much is that. 1 divided by 1.08 2 times equal to, so 7320 into 0.8573 into 0.8573, kindly multiply, you will get approximately 6275. You will get 6275. My God, this is current service cost calculation for all the years. Now please pay attention, the factor that we are using. First we use the factor 0.7350 for year 1, then we use the factor 0.7938 for year 2, then we use the factor 0.8573 for the third year, and the same thing we will do for year 4 also. 7320 multiplied by factor of 1 year, 1 divided by 1.08, 1 divided by 1.08 is the factor 0.9259, 0.9259. So that will be equal to 6778. 6778, and this last one we don't need to discount, it is at the end of year 5 only, and the payment is also at the end of year 5. So the last one doesn't require discounting. So the student will note the discounting factor we have used. For year 1 we have used 0.7350, for year 2 7938, for year 3 0.8573, for year 4 calculation how much was that? That was 0.9259, 0.9259, and the last year we don't discount it, so we'll take 1.0. So these are the factors that we need, and that you just have to multiply by 7320 every time. When you multiply by 7320 every time, what you get is called current service cost. What you get is called current service cost. So let us see step number 5. I have given the answer in your book, but whenever you have a doubt, look at this diagram, and this will 100% clarify your doubt why we are using discounting factors like this. Okay, amount accrued at the end of year 1, paid at the end of year 4, so gap is 4 year, so 4th year factor. Amount accrued at the end of year 2, paid at the end of year 5, so gap is 3 year, so I will use 3 year factors. So let us come to the step number 5. This is step number 5, very important. These are year 1, 2, 3, 4, 5. You will write allocated benefit per annum 7320, factors at 8%. Now how do you write the factors? I have explained. One more time. Here the factor will be 1 divided by 1.08 to the power 4. 1 divided by 1.08 to the power 3. If you are interested, you can write so that you don't forget. 1 divided by 1.08 to the power 2. 1 divided by 1.08 to the power 1, and this last one will be 1 only. Reason, look at the diagram I have given. Now multiply 7320 into this number 5380, 7320 into PV factor 5810, 7320 0.867 6273, 7320 0.926 6778, and the last one 7320. These are the current service cost. These are the current service cost. Now we'll look at the journal entry for year 1. We have to give journal entry. we have to prepare balance sheet, we have to prepare P&L account. So have patience, we'll do it. Journal entry for year 1, look at the above table. Current service cost for year 1 is 5380 to present value of defined benefit obligation, and the amount is payable towards bonus 5380 being current service cost recorded, and then no entry for interest cost. Sir, why? Because there is no time gap. We are at the end of year 1 only. This entry was passed at the end of year 1. Interest accrues only after 1 year. So interest will accrue on this amount, but not now, next year. If you deposit 100 rupees in a bank today the bank is not going to give you interest. Bank will give you interest after 1 year. So this is like the employee has given 5380 to the company. Employee says, you keep this money, give me after 5 years, give me at the end of year 5, give me interest on that. That interest calculation will be done in the second year. P&L account will have one item, employee benefit expense 5380. Current service cost is a part of employee benefit expense. Current service cost is a part of employee benefit expense. Then we'll go to balance sheet. Balance sheet, we are going to give extract year 1 equity and liabilities. Under that, non-current liabilities, because these are payable beyond 12 months. Provision for employee benefit 5380. Then we'll go to year 2. Look at your table, step 5. In step 5, current service cost of year 2 is 5810. Current service cost is 5810, but now I have to provide for interest on the opening liability. Opening liability is closing liability of the previous year 5380 into 8%. The discount rate is interest rate. When we are going from present to future, we'll call it interest rate. When we are going from future value to present value, I will call it discount rate. So that comes to 430. That comes to 430. Please check, round off the number to PV of DBO. So this is the current year addition to liability, PV of defined benefit obligation. These two items will go to P&L account, and this will be added to opening balance. This will be added to opening balance in the balance sheet. Okay. So let us see the presentation in the P&L account. These two total 6240 will be presented in the P&L account. Total of current service cost and interest cost, will add and show in the profit and loss account. And in balance sheet, liability side, non-current liabilities, long-term provision, provision for employee benefit. This is opening balance. Do you remember? And this is current year addition. Current year you can write, or current year addition. So every year this liability will keep on increasing. Every year the liability will keep on increasing, and at the end of year 5 the liability will become 36,600. At the end of year 5 this balance will become 36,600, which is my total liability to be paid, and then the company is going to pay that liability, and with that this account will close after 5 years. Is it right? In the balance sheet we write total amount outstanding. So opening outstanding was already there, fresh liability got added, and therefore the closing balance is sum of the opening and fresh liability, and this is what you will do every year. Is it right? So this was a very important question number 14. Question number 15. Oh my god, what a question. Okay, and this is from a reference book. Very important question. They will give you for 8 to 10 marks if at all they ask you. Do you want to know the answer of this question? Do you want to understand the answer of this question? If yes, then come to the next lecture. Thank you very much. We'll give you the answer of question 15 in the next lecture. So this was a very important session today on employee benefit. I request the student to revise it again. We have given you the logic which is not given in any of the books, reference material or any other classes also. This is how the defined benefit obligation scheme work. If you liked the lecture, you have to press the like button. If you have not yet subscribed, please subscribe to our YouTube channel. Now we have received silver button from YouTube also. That also video I have uploaded on our lecture. More importantly, share with your maximum number of intermediate student friend and ask them to watch this lecture every day. Okay, if you want the full video lecture, you can get it from our website vinod.in. You can get the study material also on full accounting standard with solution, and you can also purchase financial management video lecture, or you can purchase the financial management theory and problem booklet also, which contains all theory question, all practical numerical questions. Okay, so thank you very much. See you tomorrow. Bye bye.